If you can't read a real estate market, you're not investing, you're gambling. Today, I'm going to show you how to not throw your money away by showing you how to analyze any market and select the right property. Becoming a real estate investor is many people's dream, but many people fail to actually realize how important it is to analyze a market. My name is Zach, and for the past nearly 10 years, all I've done is eat, sleep, and breathe real estate. And I know what a good and a bad real estate market actually looks like. This is going to be the fourth video in a whole series where I'm helping you find and buy your very first rental property. Why does this matter to you? Well, simply put, the market influences everything about your property. It can influence things like prices, rents, demand, and even the type or the terms of your financing. If you're in a really good market and your economy in that city is booming, for example, like Austin, Texas, recently had a huge boom in their economy. A lot of tech businesses were moving there. Their economy skyrocketed. So what ended up happening is the market followed. Prices started to rise, rent started to rise, and if you weren't paying attention, you could be shortchanging yourself all kinds of money. But on the other side, now Austin, Texas is starting to take a downturn where prices have risen way too much. It's overinflated and it's getting very expensive to live there. And because you know that, you should read your market because it's going to help you avoid costly mistakes that could save you tens, if not hundreds, of thousands of dollars. Investing in the wrong place or in the wrong time could be detrimental to your whole investing career. Also, by knowing the market, you're going to know the difference between a good property and a good investment and a bad one. Understanding that buying a house in a certain area with a certain crime rate, with a certain economy is going to bring you a certain type of tenant, which is going to bring you a certain set of problems. So here are going to be a couple of fundamentals that every investor, in my opinion, should absolutely know to not lose money. First thing is going to be your supply and demand. This is the basic foundation for economy, and the same can be said for the real estate market. So if you have a high supply and a low demand, it simply means your supply is going to be really, really cheap. This is when you should be buying any and all investment properties you can. This is what we would call a buyer's market. Now, on the other hand, when you have a seller's market, this is when you're going to have a huge supply of buyers, but not enough houses for those people to buy. This is when those sellers can raise the prices significantly and make a lot of money. This is when you should not be buying, but in fact, selling your property sets you up for when the next opportunity to buy is. The next thing you absolutely must know is what are called real estate cycles. All a real estate cycle really is when the prices go down, buy. When the prices go up, you sell or hold. After this cycle, there's typically a small little correction where the prices dip a little bit and the process repeats itself. Now, something that follows a real estate cycle is going to be your interest rates. And more importantly, this is when a bank will try to get you to refinance your property, which you should never do. A real estate cycle can last anywhere from 7 to 10 years. And it's at the beginning of these cycles is when you should be buying properties, trying to renovate them, rent them out, maybe buying a turnkey property, doing as much purchasing during the first few years of a cycle. During the last few years of the cycle, if you're gonna do anything, you should sell. Another huge fundamental you need to really know about is gonna be your interest rate. Now, when it comes to commercial or investing, interest rates don't matter as much as they do when you're talking about your primary home. And here's why. Because at the end of the day, all you really care about is buying a property at the right price, making sure that it can rent out for more than your mortgage, you can get cash flow, and it's going to appreciate over time. So if it does all of that and your interest rate happens to be 8%, it doesn't really matter because at the end of the day, that investment property is doing exactly what you want it to do. Now, don't get me wrong, if the interest rates are super low, you should really be pushing to buy as much as you can. For example, during the pandemic, when rates were at a historic low, there have been several of my clients who bought property during that time, and they're still reaping the benefits of a 3 and 4% interest rate on their investment property. Another huge part of these fundamentals that you need to know about is things like inflation, wage growth, and affordability. It is very hard for you to outpace inflation if your money is just sitting in a simple savings account or something that's not really making a lot of money. And that's where real estate comes in, because the appreciation you gain with your equity, the depreciation you can write off on your taxes, the tax benefits as a whole, and the cash flow are going to easily outpace inflation if you do it right. But more importantly, you need to be following inflation because this can easily affect things when you're doing like a remodel or you're trying to just rehab a property. The prices of those materials could be significantly higher than you're used to. Wage growth is a huge factor in a market analysis. Knowing that your economy in your local area is starting to boom, people are making more money, that just means that people can afford more in rent, which means you can go out and buy better property. And speaking of that local economy, knowing what is happening in your city, around the area, or even in your state as a whole can hugely determine where you actually buy these rental properties. Here locally in Baton Rouge, where I live at, Amazon just built a massive, like 8 or 10 story regional distribution center, and it's massive. The area that they built it in used to be run down, and the area was slowly dying. But now that money is there back into that area, we've seen big companies like Aldi and even Guitar Center start to renovate their property, which means the houses around there are going to eventually appreciate a lot faster than they would if they did not come here. So now that we have these fundamentals in place, let me teach you how to read a market and become a professional at it. There are a few key data points that we are going to track, and I'm going to help you understand fully to help you analyze this market. We're going to talk about things like days on market, median home prices, inventory levels, rent trends, cap rates, and cash flow potential. So let's break them all down. So days on market, well, this is going to tell you how long a property has been sitting for sale. And why is this important to you? Well, because if something's been sitting for a very long time and you know you have cash and you can come in and put a great down payment and buy this property, you can have all the leverage in the world. When a seller lists a property for sale, they intend to sell it as quickly as possible, not letting it sit for a long time. Another thing that this helps you as an investor realize is if houses in your area are selling very, very fast and it's a good seller's market, and you have an opportunity to get out of a property to buy something bigger and better, you know that you can sell this house very fast if you price it right, and that can change everything for you. And going along with that is knowing the median home price. Now, the median home price is just going to be the average of what's selling in your area. You can easily find this out by going to use the free websites like Zillow or Redfin, but I would suggest you find a local real estate agent who specializes in investment properties. They're going to easily be able to help you find a good price for your house to sell it for. And now going back to what I talked about earlier about supply and demand, knowing your inventory levels in your local market is huge. If you know that there's a very high supply for your type of house, let's say you have a single family, 3-bedroom, 2-bath, around 1,500 square feet, and the market is just flooded with it, you should say, if you have to sell it, just know you're not going to get a ton more than you thought because there's such a huge supply. But if that same house is in a market where there's not a huge supply, but there's a massive demand for that type of housing, you will be able to sell it and get a lot more than you paid for it. Now look, here's something not enough people talk about, but they should. Knowing the rent trends in your area is massive, and I cannot understate it enough. Knowing when a market is going up in rent versus when it's going down can determine where you buy. If you know that this area's rents are trending upwards and they're slowly increasing over time, that's where you want to buy. But on the other hand, if those rents are not rising at all, or if they're going down, you're definitely going to want to stay away from that area. The last couple of key terms that you need to know is going to be your cap rate and your cash flow potential. Cap rate, or also known as your capitalization rate, is just going to be the percentage of the return for your investment property. The cap rate equation is very simple. It's just your net operating income every year divided by the property value. You take that number and multiply by 100 and you get a percentage. Now, every area's average cap rate is going to be different, so search for it in your area. But knowing this is going to tell you if a property is good or if it's bad, if it's on par with what's in your area, is it above or is it below? I would always suggest going with at least the average or above. Never go below unless for some reason you just love the property. And of course, your cash flow. If this property is not cash flowing at a decent rate, then what's the purpose of it? Unless you just need a huge tax write-off and you aren't looking for cash flow, most of the time, you're going to want that cash flow. Now, I've already talked about some tools that you can use to your benefit like Zillow and Redfin, but there are a few others that I personally use that will change everything for you. Number one, if you can't afford it, is getting a paid service like PropStream or Property Radar. These websites give you so much data when it comes to real estate. It is crazy. We could literally spend hours and hours analyzing a property on these websites. They're going to give you everything you need to know about that property, from foreclosure status, equity, who owns it, what's their address. I mean, everything you could ever know to find a good property. Another great tool for your local market is the census data. This is going to tell you how fast or slow your city is growing, if people are moving. It's going to tell you about the jobs. It's going to give you so many key pieces of information to help you decide on a rental property. So now let me give you some important strategies no matter what market condition you are in. So if you happen to be in a hot market where real estate is just flying off the shelves, you got maybe a lower supply and a really high demand, there's some things you can do to take advantage. Number one is looking for any property that is distressed, that has a potential for a ton of appreciation where you can buy it cheap. Now, yes, these properties usually mean you're gonna have to put a lot more work into it to actually get it there, but it can be totally worth your time if you do it right. Knowing when your area has low inventory but a high demand of something can change how you approach finding any property. Like I said earlier, if there's a huge demand for 3-bedroom, 2-bathroom houses and there's hardly any available and you're able to find one distressed, foreclosed, or even off market, that's what you should be doing. Now, what about if you're in a cold market that isn't really moving very fast or really doing much? This is where you're not going to have many wholesaling opportunities or anything like that. You might not even have many distressed properties. The foreclosure auction may be limited and it may take you a while to find a good property, but that is okay. You want to be very picky, choose your properties well and carefully, and don't overpay. And if you happen to find something that's on market that you can negotiate with the seller, know that because it's a cooler market, you can easily negotiate a way better sales price than you could in a hot market. Now, what about those markets that aren't really cold, but they're not really hot? They're kind of balanced right in the middle. Well, this is where it's time to get super creative. Look for opportunities like seller financing or sub-2 or value add properties, looking for opportunities with other lenders, hard money loans, or anything like that where you can get ultra creative on how you finance a property. And look, I don't want you guys going out there thinking, you know what, this market is too confusing. You know what, how do I find money? How do I do all of this other stuff? Well, that's where the other 3 videos in this series comes into play. Go ahead, click that playlist down below in the description to see the other videos on how to find money and how to analyze any property like a pro.